Well, it looks like Salesforce is doing it again, doing the thing that they're known for.
If AI is the Wild West, does that make data the new gold? Huh.
To Salesforce, data is the new gold. And Salesforce wants to buy more data, or at least more data companies. Investors don't want Salesforce to buy anything. They want Salesforce to just grow organically. But Salesforce, in many cases, they do what they've done before, which is they do whatever they want. And what they want to do is more acquisitions. This time with a company called Informatica. It's a company that Salesforce apparently has been eyeing. They've been looking into, and they've been having deep conversations. These aren't just initial talks. These are like deep level conversations of buying this company, Informatica. The Wall Street Journal broke this news a few days ago. Bloomberg has reported on it. Seems like it's a real report. And we're going to dive into this news and see what this means for Salesforce. Recently, I bought into a large position in Salesforce. I made it one of my core holdings in my primary portfolio. I was very bullish on the company. But here we have news that they're returning to their old ways of doing acquisition-based growth, or at least they're rumored to be doing so. So in this episode, we'll be looking at this potential deal. We'll be going over Informatica. This is a $10 billion market cap company. So it's a lot of money that Salesforce would be spending to buy this company. What does Informatica do? Is it worth it for Salesforce to buy? Why do they want to own it? And why are they now starting to do acquisitions again? And furthermore, what am I going to be doing with my position? Salesforce has taken a beating over the past couple of days as investors have not liked this news. Right now, it's down currently 7% just over the past week, just over the past few days, based on this news alone. So I'll be letting you know what I'm doing right now with my position as well. So we have a lot to get to in this episode. Let's go ahead and jump in. Now, the first thing that I think would be helpful is looking at the company in question. What is Salesforce rumored to be buying? Well, the company's called Informatica. At its core, Informatica is primarily used as a robust data integration tool. So if you want to integrate data from one platform to another, from one cloud provider to another, from one app to another, they have the integration tools to do that. So there is some overlap to different companies. There's a little bit of data visualization that's similar to like Domo or Palantir. There's some API integration tools that's similar to MuleSoft. But overall, they have their main focus, which is data integration from one platform to another. So that's basically what Informatica does, and we can look at the performance of this stock over time. Informatica is publicly traded. The numbers are on Qualtrim. We can look at them right here. It looks like it went public in 2018, and it had $1.23 billion in revenue, and it's slowly grown its revenue over time at a pace of around 5.5%. So you have a company that is growing around 5.5%, and their estimates are that they're going to grow revenue again around 6% next year. So this is a slower growing top line. It's slower growing than a lot of companies in my portfolio. Texas Roadhouse has grown its revenue double the speed of this company. In fact, actually around triple the speed of this company. In some cases, these companies that grow a little bit slower have good economics, but this is slower growing than I would like. Keep in mind that over this time period, inflation has been like 3 to 5%. So when you adjust for inflation, this is very stagnant top line growth, not something that I love to see. I'd like to see the growth somewhere closer to 7 to 10%. That's a little bit above inflation. That shows that the company's actually growing organically. We can jump over to Informatica's free cash flow and take a look at this. And this has been going up over time, in fact, a little bit faster, which is nice to see. In 2018, it was 172 million. In 2023, it was 259 million. So the free cash flow went up around 100 million over that time period. And it's grown around 8.5% over the past 5 years. Informatica's balance sheet is getting better over time. You can see in red here, the long-term debt is going down, and the green, which is the cash balance, is going up. So it's trending in the right direction, but they still have currently not a great balance sheet. They currently have $700 million more of long-term debt than they do cash. So this company still has to pay off a lot of debt that will take years to pay off. Finally, we get to the shares outstanding. Like many immature companies, this one went public in 2018. the company is still diluting. It's in that immature phase of issuing more shares. In this case, having green numbers here, meaning that they're going up, is not a good thing. We want the numbers to go down. They're buying back shares, increasing your equity in the company. But in this case, over the past 5 years, they've issued around 1% additional shares outstanding per year. Just last year, they issued 2.65. So that was a decent bump up from 2022 to 2023. Not a trend I like to see. I want to see companies that can do buybacks. When I look overall at Informatica, I view it as a mediocre company, one that doesn't come close to meeting the qualifications to be in my portfolio. It has too slow of growth. It doesn't generate enough free cash flow. The company doesn't have a strong enough balance sheet. They're doing dilution right now. And even after that, the company is at a valuation that doesn't meet the fundamentals. The valuation right now is at a 36 forward PE. Why is a company that has 6% revenue growth and flat free cash flow over the past couple of years trading at a 35 forward PE? This is the price that a company like MasterCard trades at. MasterCard trades at like a 31 forward PE. MasterCard has incredibly reliable, consistent free cash flow growth. MasterCard grows more than 6% per year. And MasterCard has a much stronger, in my opinion, a much stronger moat than Informatica. Informatica and their data integration business is in a highly competitive market that has many more players than payments. So when I'm looking at this company and comparing the fundamentals with the current valuation, I believe it's expensive. And part of the reason it's expensive is because the market has anticipated that Salesforce will buy it. In fact, when we go into the exclusive report from the Wall Street Journal, we can see that Salesforce wanted to buy this company at a cheaper price. We look at the report here and it says that the California-based Informatica has a market capitalization of more than $11 billion after a 43% run-up in its shares this year as traders bet on a deal. So traders are betting that Salesforce is going to do what they've always done. They dive deep into their pocketbook. They use their huge cash balance and they dish out a lot of money to buy products. Like they bought Slack for $26 billion. And they're going to do the same thing with Informatica. They're going to buy this company for 10, 11, 12, 13 billion dollars. So traders got ahead of this and bid it up. One potential impacting factor is the price that was being discussed is below Informatica's Friday closing stock price of $38.48 as a result of the recent jump. So Salesforce, during these discussions of potentially buying Informatica, were discussing buying it at a lower price than it trades today, which puts a kink in the deal. So it doesn't make sense for Salesforce to pay an even higher price because their discussions are what led to this price going up in the first place. So this whole situation's a bit messy and it's unclear whether or not this deal will go through. Salesforce hasn't commented on this. They say that they're not commenting on rumors. So we don't know if they're still going to do this or if they're pulling out of these discussions. But either way, the stock is reacting very negatively. Wall Street has sold down Salesforce 7% just over a one-day period. And it's because of this news. Why do investors not like this news at all? That is because it's somewhat of a bait and switch. A year ago, Mark Benioff, the CEO of Salesforce, he talked about how Salesforce was changing, maturing, and adapting. Investors in the stock and many activist investors were pressuring Salesforce to stop doing expensive acquisitions, stop buying different companies like Slack, and focus on growing your own products organically. And that's exactly what Mark Benioff said he was going to do. Mark Benioff said we're focusing on profits and free cash flow, margin expansion, and share buybacks. All of these things were like music to investors' ears. And Salesforce stock ran up from $200 to $300 because Mark Benioff was focused on streamlining the business, firing off excess employees, raising margins, and focusing on organic revenue growth. But then only a year later, we're hearing news that they're potentially in deep talks to buy another $10 billion company. It seems like a bait and switch. It seems like they're not doing what they say they're doing. So that lack of clarity has caused investors to sell out of the stock over the past couple of days. But in my opinion, I don't think it's a big deal. And I'm not going to be selling out of Salesforce. In fact, what I'm doing right now is buying a lot more Salesforce. In the past 2 days, including today, I've been doing incremental buys into this company. I've wanted to get into Salesforce, and I've been looking for opportunities to increase my position in it, specifically based off of rumors or scary things that happen that really don't affect the fundamentals. And this seems like the perfect opportunity in my case. Salesforce has traded down meaningfully, around 8% off of a rumor that they're buying a company. This isn't even something that's official. Salesforce could likely not buy this company. There's a very good chance they won't. So this is rumor news causing the stock to sell down, and Salesforce still remains what I believe is an undervalued compounder, a company that will do really well over the next 5 years. So given this sell-off in the stock, I've purchased another $5,000 of it yesterday, and I'm going to be buying another $3,000 of it today. I'll use this opportunity to buy into the stock. Now, I don't know if it will sell down further, so this isn't trying to time the bottom, but I do know that Salesforce is now at $270 per share. A couple days ago, it was $300 per share, and I like that discount. Financially, Salesforce has the money to easily be able to do this acquisition. If we look at their cash balance, they currently have $14 billion in cash. And in long-term debt, they have right now $5 billion in long-term debt. So they could almost entirely pay the $10 billion with just their excess cash. Now, even though they could afford it, I'm hoping that they don't. I hope that Salesforce does not buy this company. I believe Salesforce could create more intrinsic value for their shareholders by using this excess $10 billion in cash to buy back their shares. I want Salesforce to start aggressively buying back their shares every single quarter. And I think if they do that, I think if they use their excess cash to buy back shares instead of doing other acquisitions, it'll increase their free cash flow per share metrics even faster. It'll increase their earnings per share metrics even faster. The company will grow faster. So I'm of the opinion that I think Salesforce is better off not doing this acquisition. But even if they do, it still would not be a dramatic impact over their long-term future. So overall, I see this as two different scenarios. One scenario is that Salesforce doesn't end up buying Informatica. This is just a rumor that comes and goes, and they scrap the deal. In that case, I'm buying more of a great company that I already own at a decent discount. I get to buy it at $270 instead of $300. The second scenario is that Salesforce goes through with the deal, that they fork over $10 billion to buy this company. Even in that case, I think it isn't the best thing for Salesforce to do, but it's still not the worst outcome. They could be buying much worse companies at much worse valuations. Informatica is a decent company with a decent product that would further solidify Salesforce's massive monopoly over software. So even in the worst case scenario, I don't think it's too bad. And that's why I'm buying more of the stock. In either scenario, I feel fully comfortable owning more Salesforce. Now that's going to be it for this time. Hope you enjoyed. See you in the next one.